Today we are going over how banks make money. Welcome to Wealthier Mindset Academy, a place for the motivated 1% that refuse to be average. If you want to be a millionaire or even a billionaire, one day you need to learn everything you can about personal finance. Remember to like, subscribe, and leave a comment below. Do you ever find yourself wondering how banks work? Is a bank a real business? Where does your money go after you make a deposit? Does the money get locked in some secret vault? Well, that's not exactly how it works. What types of banks are there in the United States? There are several different types of banking institutions that all work in almost exactly the same way. Before we get into exactly what the bank's function is in the United States, we want to go over the different types of banks you will come across in the country. Keep in mind that the lines aren't drawn with permanent marker here. Some banks might offer a variety of services spanning across the different types of banks in our list. Retail banks. Retail banks are the ones you come across most often. These banks focus on the consumer and provide the public with a place to deposit money into their own checkings and savings accounts. These kinds of banks give credit cards, offer loans, and offer numerous locations for you to manage your finances. Commercial banks. Wikipedia's definition of a commercial bank really hits the nail on the head. Basically, a commercial bank is an institution that provides services such as accepting deposits, providing business loans, and offering basic investment products. These banks started out with the aim to serve the business sector and not just the general public. These banks rely on lines of credit to manage cash flow and provide any other kind of service a business might need. Credit unions. A credit union is a member-owned financial cooperative, controlled by its members to provide credit at competitive rates. In other words, a credit union is a not-for-profit organization owned by their own customers that offers banking services to its members. Although similar to commercial or retail banks, credit unions differ in that the members share common characteristics like the location of where they live, what occupation they have, and where they work. Savings banks. Savings banks provide a place for people to save their money and accrue interest on their money over time. Savings and loans. Savings and loan associations specialize in accepting savings, deposits, and making mortgage and other loans. Online banks. Online banks operate entirely online and do not offer physical brick-and-mortar locations for you to manage your finances at. These are becoming more popular as our world becomes more digitized. Mutual banks. Mutual banks are similar to credit unions in that they are owned by the members or customers instead of outside investors. Central banks. The central bank is the big dog that manages the monetary system of the government. The Federal Reserve, central bank, is responsible for managing economic activity and supervising banks. When you make a deposit into your bank account, the bank turns around and lends this money to some of its customers. You as the depositing customer will be rewarded with some interest back on the money you deposit. The bank lends your money to another customer and charges them a higher interest, usually higher than the interest they pay you. This is how banks make money on the interest difference. It's not any different from you buying something at a low price and turning around and selling it at a higher price. Please like and subscribe if you haven't already done so. It's difficult to understand how banks work when they don't produce tangible products. You may have come across banks that entice consumers with incentives like free checking account, no fees, free deposits, etc. To better understand how this works, let's use the following example. You, the customer, deposits money, let's say $20,000 into a savings account that will pay you 0.55 APY, annual percentage yield. This is simply the rate you will earn on your savings or investment in a year. The bank turns around and lends your money to another customer. Mortgage at 6.50% APR. Car loan at 5.50% APR. Credit card at 17.99% APR. Now you are starting to see how this can be very profitable for a bank. You get paid a small amount for letting them use your money and they go out and make more. To put this into perspective, if a bank has millions of customers and they repeat this process repeatedly, that's a good chunk of change. The Federal Reserve, central bank mentioned in our list, is what regulates the lending of money by setting reserve requirements that indicate the amount of money banks are allowed to lend. We will paint a picture for you in the following example so you can get a better idea of what we mean. Let's say you put $1,000 into your bank account into an American bank account. Of that $1,000, the bank is allowed to lend out $900 of the total you have put in. Based on this example, what would be the reserve requirement for how much money the bank needs to keep from lending? Take a second to think about that question. In other words, what percentage of your deposit did the bank have to keep in its reserve? Okay, now for the answer. If you said 10%, then you guessed the reserve requirement set by the Federal Reserve. Banks are allowed to lend out 90% of your deposit and cannot touch 10% of it. The $900 from your $1,000 deposit goes back out into the economy and ends up deposited into another bank. These banks are then able to lend out 90% of the $900 that was put into the account, and on, creating an exponentially increasing amount of money in the economy. Does the Federal Reserve ever change the reserve requirement? That is a great question. Depending on how the U.S. economy is doing, the Federal Reserve will regulate different metrics, Fed tools, to fit the economy's needs at the time. So if the Federal Reserve lowers the requirement, that means less money will be held onto, consequently pumping more money out into the economy. The fancy term for this process is called the expansionary monetary policy. If the Federal Reserve wants to slow economic growth and reduce liquidity, amount of money in the economy, they will raise the requirement so that less money gets put into the economy. The fancy term for that is called a contractionary policy. The lower the requirement, the more money banks get to make off your money because it's more money they can lend out. Banks love fees for a reason. Banks make money is by charging fees in different ways. Account fees. Banks can make money with fees by charging checking accounts fees, investments, credit cards, personal loans. They are also known as maintenance fees and they make their profit. ATM fees. We have all been at an ATM and got that message telling you, you will be charged for using that ATM. Guess who is pocketing that money? You guessed that right, the bank. Penalty fees. Banks love it when you are late on your payment. It could be a credit card, car, or mortgage payment. A check that was insufficient and bounced. The fee that you pay is profiting the bank. Every time you are late on payments or bounce a check, you are making your bank richer. Investments commissions. If a bank has a brokerage division, they make commissions anytime they execute trades on behalf of their client. Loan application fees. When a customer applies for a loan, majority of the banks will charge what they call an origination or application fee. This fee can be included in the principal payment and the bank will charge you interest on that fee as well. Friends, please don't forget to like, subscribe and leave us a comment below. We love hearing from you. Thank you for watching and turn on the bell notification to get notified anytime we release new content.